I'm Megan Marsh of Keystone Alliance Mortgage and Keystone Capital, and we are a mortgage broker who have helped thousands of home buyers stop renting and start building wealth without having to use all of their hard-earned money in their bank accounts. And before we move on and compare these three programs and how to get you into that house with as little as possible, make sure you subscribe, hit the bell so that you keep getting these videos that will educate you so that you can make a smart decision when you buy the biggest asset of your life. Are you looking for a home loan that accommodates, number one, low down payment, number two, has easier credit and requirements, and number three, has a payment that fits and meets the monthly budget that you would like to stay within? In this video, I am going to be sharing with you my tips and tricks about the three known superstar home loans, FHA, USDA, and conventional HOMEREADY and HOMEPOSSIBLE. And I'm going to go through the differences with each one of these programs. So let's go take a look at each program and so that you can determine which one suits your lifestyle and your needs more and which one would be a better fit when you purchase a home. And if you'd like to follow along with the numbers and test it out yourself, we have a mobile app that has a calculator on it in each of the programs so you can plug the numbers in. So pause this video and go and text the word Keystone Team to the number 44222 and get the mobile app on your phone and then follow along as we walk through the three different programs. So let's talk about first low down payment using as the least amount of cash out of your pocket, because I know it's super frustrating when you've saved up all this money and to think you're going to completely empty your bank account when you buy a house. I don't think that's the best option, and I'm sure you don't either. You want to leave some money in your account for the unexpecteds, the things that are going to come up, and all the things you're going to need for your new house. So how do these programs then help you when you're going to buy the house? Let's start with the one that requires the least down and what that program will also allow you to get in what's called seller's assistance. So these two pieces, we're going to start with USDA. USDA is the lowest down payment option that anyone who purchases a home in USDA territory, which we will go over, is allowed to use. So USDA, when it comes to the down payment, requires a 0% down payment. So just for ease of numbers, we're going to use $100,000. If you're buying a house for $100,000, USDA will require 0 down. And then they will allow you to ask the seller for up to what's called 6% in seller's assistance, which means besides a down payment, you also have closing costs and prepaid items, and those amounts are usually going to cost somewhere between 5 and 7% of that purchase price. So in our example of a $100,000 house, you don't need anything down on that USDA loan, but you still have about $5,000 to $7,000 in closing costs and prepaids. You can say, Mr. Seller, I'm going to pay you $100,000, but I would like 6% seller's assist. You are allowed to go up and ask for up to 6%. So now, let's say you had $7,000 in closing costs and the seller agrees to give you 6%. You do $7,000 minus $6,000, you need $1,000 to get into your dream home. It's almost like putting a deposit down on an apartment, right? And so USDA is the winner when it comes to least out of pocket. The second loan program is FHA. And FHA can get you pretty low, not as low as USDA, but there's no requirements on where the house is. Now FHA, their down payment is 3.5%. So on that $100,000 house, that's $3,500. That's the amount that you have to come up with no matter what. The closing costs, just like in the last example, FHA does allow you, like USDA, it allows you to ask for up to 6% in seller's assistance. So in a lot of cases, you can get assistance from the seller to cover almost all the closing costs, and it's going to leave you with needing to part with 3.5%. And that's why FHA is a pretty close runner-up to the USDA loan. I also want to add, for any of you listening, that FHA is not just for first-time home buyers. All of the programs that we're talking about today can be used for people who are buying their second home. The only restriction that two of these programs have is you cannot own another home when you purchase. The only one that allows you to own another home is FHA, the one we just went through. So let's finish up and talk about the last program, which is our conventional option, the HOMEREADY and the HOMEPOSSIBLE. So HOMEREADY and HOMEPOSSIBLE are a type of conventional loan. And the down payment requirement for these programs is 3%, a little bit less than FHA, still more than USDA. So you'd need $3,000, where conventional and HOMEREADY and HOMEPOSSIBLE fall a little short behind our FHA and USDA other programs is that conventional loans only allow you, when you're putting 3% down, you can only ask for 3% in seller's assistance. So you are going to have to pay for some of those closing costs because you can only ask Mr. and Mrs. Seller for 3% or $3,000 instead of that full 6%. So they're all great programs. All of you can use them as long as you follow the requirements. Let's move along and go to the second category, which is what kind of credit do I need? What kind of income? What are the qualifications to be able to get into these 3 loan programs? So now let's talk about our 3 programs with credit and the requirements to use one of these programs. I know it's always something that we're just not sure about. What does my credit score need to be? What does it need to be to get into these loans? How does it affect the loan? So when it comes to the loan programs, there definitely is a winner. Let's start with our USDA, our lowest down payment program. USDA has a requirement that, and usually, just to note, it's the banks that set the requirements. A lot of times, USDA and FHA, they will allow for some flexibilities, but a lot of banks have their own requirements. A good rule of thumb for USDA is about a 620. They're going to want to see a 620 to be able to do a USDA loan and qualify for it. What they do say is that you need to have at least 2 credit scores. So if you're someone who hasn't really established credit yet, USDA is not going to be the loan for you, or you're going to need to wait until you have built up a little bit of credit. The biggest restriction with USDA is the debt to income ratio. USDA likes to see your back end ratio, which means your mortgage payment and all the other debt you have. They want to see that debt to income ratio stay under 41%. And we do have a video on qualifying and how much you qualify for that you can go watch to see how banks calculate your qualifying, how much you qualify for, your debt to income. But USDA is on the stricter end of the 3 programs when it comes to your debt to income ratios. The last piece that I wanted to mention about USDA loans is that they are income restricted. So if you are making a very healthy living, you might not qualify for USDA. I will say, though, compared to all the programs, that I think they're pretty flexible, and it depends on your area and your state. And so I am going to put a link down in the description that you go to for USDA. And when you click on it, if you go and you put an address or you want to check your income based on your household size, then that will tell you what the cap is on your income. And USDA homes also are only in certain areas. It's not in the middle of the boonies, but it definitely is based on population and where you're looking. So let's move on now to FHA, or second. And I think that FHA is the gold medal winner when it comes to credit and qualifying. FHA is the most lenient, the most flexible when it comes to all of these things. Now, there are a lot of banks out there that might tell you, oh, FHA minimum credit score requirement is 640, 620. That's not true. FHA, which is the Federal Housing Administration, they don't have a minimum credit score requirement. What they do have is all of us who help people get into homes and get them loans. We have a system that we put all your information into and we run it through, and it will tell us if you're approved, if you need to be manually underwritten, which means we don't get an approval, but we still might be able to get you approved. And that's part of those flexibilities with FHA. Traditionally, though, you're going to see lenders are going to want at least that 620 to 640. Mortgage brokers like Keystone Alliance Mortgage are going to have lenders that will allow you to go down into the upper 500s, the 580 mark. And then the last piece of it is debt to income ratio. FHA loans are also more flexible with debt to income ratios. And it's that underwriting system that will tell us, whereas USDA said 41% is what we want to see, FHA will approve buyers with 45, 48, 52. We've seen them go as high as 56% on FHA loans. So let's say you have a second job that we can't use for income. It might still be okay with FHA because they will allow your debt ratios to expand a little bit. FHA doesn't have an income restriction and they don't look at where the house is. So for that reason, that is why FHA is my gold star winner when it comes to credit and then the requirements to get into a home using FHA. And our last one, which is our conventional loans, the HOMEREADY and the HOMEPOSSIBLE, it kind of sits in the middle of these two programs. Conventional loans traditionally want you to stay in that 41, but I've seen it go as high as 48% on the debt to income ratio rule. What it does do is they do have an income restriction on the HOMEPOSSIBLE and HOMEREADY to do the 3% down, unless there is, once again, like USDA, they have a little map, and if you buy a house that's in a certain designated area, it waives the requirement, waives the cap on your income, and anyone can use the program if they buy in an area that is identified through HOMEREADY and HOMEPOSSIBLE's mapping geo-targeted areas. And so a little bit lower on your DTI, no restrictions on where the house is to use it. It just comes down to the income is the main piece with the conventional programs. And then the last part, credit. So conventional loans, this is the one tricky part, is that the credit requirements. You have to at least have a 620, although I found that conventional programs typically like to see most home buyers above a 660. And it's really in that 660 range and above a 680 that it has some of the best benefits. And it's going to move us into our last category, which is monthly payment. What do these three programs do for your monthly payment, and how does it help you long term when you have a mortgage payment? So we've gone over down payment, we've gone through the credit requirements. The last piece is, what is my monthly mortgage payment going to be? And this is where that mobile app, if you've downloaded it, open that up, because that app and the tools in the app are going to help you see exactly what I'm talking about. Otherwise, you can look here and we'll go through how these three programs affect the monthly mortgage payment. So mortgage payments are going to have 4 different pieces. You're going to have your principal and interest on the loan. You're going to have taxes. You're going to have insurance, and then mortgage insurance. Taxes and insurance are always going to stay the same no matter which loan program you do. Let's go through the difference, though, in the interest and the mortgage insurance. So USDA is also one of the gold medal winners in this category of keeping your payment reasonable. And the reason is because it does not matter if your credit score is a 620 or a 750, your mortgage insurance and your interest rate are going to be pretty much the same no matter where your score falls. And so if, let's say you have, and it has the lowest of the 3 programs, we'll show you here on the screen that on a $100,000 house, if you're using a USDA loan, the monthly mortgage insurance is only $30 on that USDA loan. But it stays on for the life of the loan. It never falls off. If we move over to FHA, FHA also is great because it keeps that monthly mortgage insurance the same, but it's higher than USDA. Whereas USDA is about $30, FHA is about, I think it's $61. So $61 is double. So I see a lot of times when people are looking at buying, FHA's payment, even with a down payment, has a higher payment than USDA. And then the third program, which is our conventional loans, is going to kind of meet somewhere in the middle, but it's all going to depend on your credit score. All conventional loans out there, today we're specifically talking about HOMEPOSSIBLE and HOMEREADY, but all programs in the conventional arena They have tiered interest rates and tiered mortgage insurance based on what your credit score is. So if you take that app and you put it out, put a price in. You could use the 100 that we're talking about. You could use 200 if it's the average in your area. And if you put it in there, let's say you have a really strong credit score. Well, if you have a really good over a 740 credit score, your mortgage insurance that's going to be in your payment is going to be about $47. If your credit score falls and let's say it goes down to about a 655, it's going to double or triple that mortgage insurance. So that's where, depending on where your score falls and how much money you have, that's how we try to figure out and see where and what fits you best. But I think the key to any of these programs and the person that you choose to work with when you decide you want to purchase a home is that it's someone who's going to talk to you and teach you about these pieces in the process. And even if they know that HOMEREADY isn't the right program for you, you don't know that yet. And I think it's one of the most important things is to have someone who's going to show you and look and say, all right, here are the two programs. I think this one's best, but I wanted to show you this one anyway. And really, when it comes down to USDA, which everyone would love to use USDA, it's going to matter where you look for the home and what your income is. So I hope that's helped you get some clarity and value out of this video for getting ready to go purchase your first home. So if you're ready to buy and you would like to speak to one of our loan officers or team members, you can click the link down in the description and we would love to help you get started on your journey to becoming a first-time home buyer or a second-time home buyer using one of these programs that you probably didn't know that you could use again and again. You can also visit us on our website at KeystoneAllianceMortgage.com, or you can find us on Instagram and you can find us on Facebook. Otherwise, see you next time. Make sure you subscribe, hit the bell so that you get notifications and continue to learn and educate yourself so that you can go and get one of the best programs with a low down payment and a great monthly payment that fits your budget.